Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, the #1 value investing podcast in the world, sitting next to Geoff Gannon. Geoff, how's it going today?
It's going really well. How's it going with you?
It's going fantastic. I always wait for the how's it going with you, but it's going great. As always, we hope it's going great for everybody else as well. Hey, if this is the first time that you are tuning in with Sir Jeffrey Harvey Gannon and myself, be sure to check out all of our work. FocusCompounding.com. Geoff blogs about ideas. 250 plus write-ups this year. Insane. 250 plus write-ups. And if you want access to that, be sure to sign up.
That's planned. 250 planned.
Nope, 250 plus write-ups
Okay.
of a bunch of different stocks. And we're actually going to be going over pretty much every spinoff going forward as well. I compiled a new ecosystem for us.
Something written about them. They won't all be long.
Yeah. So definitely sign up on the premium website for that. And if you do sign up, use the podcast promo code, which is podcast. There is a stocks A to Z section on there with over 100 different ideas, mainly overlooked, a lot written by Geoff, some written by other members, but it's all pretty solid content, I would say. If you like free stuff, sign up on the homepage for our email list, the Gannon Gazette, the famous Gannon Gazette. We're polling a Benjamin Franklin, and if you want to have something from us for free in your email box, which has a idea for free that was written up on the premium side of the website, you can sign up for that at the homepage. If you like the work that we're doing here as well, obviously a rating, review, hitting that subscribe button goes a long way for us. So in today's podcast, we are going to be talking about sitting on your ass.
Okay.
I came across this article that you sent me, which I thought was great. It's called Sit on Your Ass Investing. And obviously Munger has talked a lot about that. I think that actual quote comes from him. But I think we should talk about like the art of selling. You and I have privately talked about selling a lot.
Okay.
I don't know if we've actually done a podcast itself on selling. So I figured why not chat about it. And in this write-up, which you could see because we record our screen now,
Okay.
if you're on the YouTube side of things, he just goes through a bunch of, he talks a little bit about John Huber's his annual letter when he was talking about if you just essentially own Apple, you outperform pretty much the whole market and every sort of active manager. But then he was going through different quotes from, I guess, great investors on selling in general. And you and I, when we've spoken privately about this, one thing that you said to me that I thought was interesting one time was you said you think people should never sell. And over time, your bad investments become just such a small part of your portfolio, and your winners essentially become such a big part of your portfolio. So why do you think that way? Take me through that thought process, and let's dive in.
All right. So that applies to individual investors, I would say. If someone asks me what is the best way an individual, not someone managing money for other people, should invest, I would say spend all year long thinking about what should I buy. Then you buy it, and then you forget that you own it. Because next year you'll put new money in at the start in something else. So I'm not suggesting that you put in a huge amount of money into something and keep and never cut it back, right? But if you know that you're never going to buy more of it, right? So you're diversified by year, someone doing this. And this is common for people because they're saving money, right? Individuals are usually saving some amount of money each year and they could put it into something. Then you're best off that way because if you made a mistake, it'll shrink down to a smaller part of your portfolio, right? You'll end up risking less and less on it in future years. And if it is successful, then it'll become a bigger and bigger part of your portfolio.
So this is for individuals that are constantly adding money.
Yes. The issue, which you can get into for why some money managers and stuff might not do this, has to do with certain concentration levels and stuff. If you start at very high concentration levels, it can become a problem. And if you invest somewhat differently than we do, a little more speculatively in some things, it can become a problem. So I'm thinking like, I think Bill Miller at one time owned a lot of Bitcoin or something, right?
Yeah.
And then it gets to be half your fund, then you probably want to spin it off or sell it or something, right? Owned Amazon, and it gets to be too big, then people start saying, oh, well, you just own Amazon. Ben Graham, if he hadn't spun out Geico, distributed to his investors, it would have been mostly Geico at some point. And
Sure.
so a lot of people don't want you to manage something that's mostly something like that, right? But for an individual, it doesn't matter. It doesn't matter to you that half your portfolio ends up in Apple, you know? And then in future years, you'll put it in different ways, right? So you're not making the decision to go 50% into Apple. That just happens naturally because you've owned it for 10 years.
Sure. I'm going to read you some of these quotes and get your thoughts on it. Of our most costly mistakes over the years, almost all have been sell decisions. What are your thoughts on that?
Mathematically, that's certainly true for me. Since I started investing, the most costly in dollar amounts mistakes have been selling. Yes.
Why do you think that is?
Because the stock continued to do well for like 10 or more years.
Do you think people, and not just you, but like investors in general, they almost get like anchored to, okay, well, this stock has been going up so much, because you don't sell because of valuation typically. It's always because you have a new idea that you like more.
Yeah, it's just a lot of new ideas. Now, if I had a huge portfolio, maybe I wouldn't mind. So if everything was a 1% position to start, then maybe I wouldn't mind to let something stay forever, but eventually sell it to buy something else. You get bored, you buy something else, all those things that happen to people.
Doesn't seem like whenever you read about maybe these individuals that weren't active investors themselves, like as of like they weren't in the business themselves of managing money. Whenever you hear about, I don't want to say these average Joes because I'm not trying to like discredit or anything, but let's just say these average Joes that somehow they die and they have like $15 million or $20 million, and then you read about the way that they would invest, and it was always they just bought it and they never sold it.
Yeah. That's true.
Haven't you? Don't you think it's kind of like that?
Yeah,
From a lot of cases that you read about.
Obviously, in terms of fortunes that people would make, that's how it would be.
I was reading an article once about I think it was a janitor.
Okay.
Or he never made more than, I don't know, whatever, probably $50,000-$60,000 a year, probably less than that. And he died, multimillionaire. And it was because he would just buy stocks his whole career or his whole life, and he just never sold it. Never sold a stock. He would just always kind of do what you were just talking about doing.
Right. So that makes sense. And
Phil Fisher was kind of like that too, right?
Yes. Yeah. So Phil Fisher was that way. Now, Phil Fisher is interesting that way because I think he started with some smaller positions and then he would like add to them as he learned about the company and got to be real comfortable with and stuff. But of course, that's how Buffett did it. I mean, in terms of Berkshire Hathaway. So the thing that's kind of funny about it is when people talk about copying Buffett and stuff, what they never talk about copying or seem to almost never talk about copying is he basically starts buying a stock, buys it for a while, right? And then he gets a certain position in it, and then the price goes up or whatever, and then he stops buying, and then he pretty much doesn't add or take away from it after that. So like Washington Post or something, he made a lot of money on, and he basically didn't add or sell it in a meaningful way after that, which is not how most people approach it, right? They either trim it back to become more in line with everything else, they sell it pretty quickly, or they add. They both add and subtract from it over time. You see a lot of that where people kind of trade around the position, which is something he never did. It's hard at times, though, because using the Washington Post example, I think he was down in that stock the first 3 years, but up about 30% a year over the first 10 years, right? Yeah. And, of course, it still is true that something like that, I would say if you're an active money manager, sure, you're going to maximize your returns by owning things for, say, 10 years usually instead of 30 or something. And that'll even be true with Apple. If you bought Apple at a point where it was just turning around to being consistently profitable and everything, the first 10 years for Apple is probably going to be a lot better than the next 10 years. That's still true. But your return over the entire time period is still pretty good. And, there are other benefits to it.
What are some characteristics, though, of these stocks that you think you could really own for a long time? I mean, it has to be the jockey that you're betting on, and also the business has to have, I would imagine, an enormously long runway. And maybe even I don't want to say, because look, we focus on companies that are predictable, but I would say even the ability to innovate and kind of, constantly innovate and stuff like that. I mean, even if you look at Apple, for example, I mean, look how much they've innovated and they have changed, going from just like, the computer to, iPhones and, doing everything else that they do, their ecosystem, the App Store, now they're in the watch business. They're constantly innovating. And I know a lot of people like to say, oh, they're not innovating, Apple's dead, blah, blah, blah. But I mean, it's just not true,
Yeah, and that's the Phil Fisher approach, is to have new areas for them to go into. I think it's hard to know how big the runway is for a lot of stocks, not all of them. There's stocks like I think of, Walmart, Southwest, Starbucks. From the moment that they were fast growers on, people knew that, oh, well, an airline could get really big. There's a lot of room for a lot of coffee shops. There's a lot of rooms to cover the whole country with retail stuff. But for a lot of these, like you're saying, Apple, at each stage that you're in, could you have foreseen that they would have gone into all those different areas, I mean, where they make most of their money from is something that didn't exist
Sure.
as a
Yeah.
realistic option, as smartphones and stuff. So, I'm sure that there would have been people saying the runway isn't as big as that. So that's the hard part of it. You have to have high returns on capital.
Yeah, that's
and
what I was going
a
to
place
read.
to reinvest it.
Yeah, the best businesses for a long-term investment, therefore, are those with both enduring high returns on capital and attractive reinvestment opportunities. So the
Yeah,
return on
those are the two.
incremental invested capital.
Yeah, that's the issue. And so we talked about it. For me, the one that would be the most obvious thing to buy and hold forever would be to find a small bank you like, because it'll be around. Banking will be around for as long as you're going to be living. And the opportunities to reinvest in it are basically unlimited. A small bank could grow much faster than any other bank for a very long time and still not have that big market share.
Now, what are some qualities that you would want to see in that bank? Because I mean,
It has
banks,
to have high
I think there's
returns
more
on it.
public bank companies than
Yeah.
any other company, or
Yeah.
and on the
It
planet.
has to have high returns on equity, and then it has to have some way to reinvest it. The some way to reinvest is hard for a bank. So most of the ones that you'll see that are small banks are community banks, and it'll be very hard for them to expand outside the community.
Okay.
So that's the hard part of it.
Okay.
So if you have anything that you can do that you can expand outside the community, then you could have success. But you have to figure out why that is. If they have any sort of success in going into new markets, they're different things. I wrote up a bank BOK Financial, and it had some success innovating with certain things, going into new markets, doing some things like expanding somewhat to become more of a regional bank over time by entering sort of like doing a tiny acquisition of some branch somewhere or a tiny acquisition of some team that did a certain kind of lending, and then trying to expand that, experiment with it, and then expand it in a big way. So there are ways to do that, but there are most banks that you're going to see that are successful at a really small size are real community banks. They never get to like the regional type size. Whereas like when Buffett invested in Wells Fargo or something, it was already showing a success for a long time to, and really it was the predecessor bank, which wasn't called Wells Fargo, that it really had the success in expanding into new markets and just a real sales-oriented culture and stuff like that. Customer service-oriented, yeah.
What about when he invested in Bank of Rockford?
So that's an interesting one. That actually grew pretty well too.
Because he paid what 2 times book for that?
Yeah. So the story there is basically that they brought in. It was a very efficiently run bank, and they brought in a lot of like CD type money, right? So it was just an operator. I think that if you didn't have the president of that bank running it, it wouldn't have been as successful. So that's the other one. And that happens a bunch. I can think of a bunch of banks where I'd have pretty high hopes for it if the person that you knew was running it now continued to, but after their time there, I don't know about it.
But what makes a bad bank, right? Let's talk about a bank that a lot of value investors like, Bank of Ozarks. I'm trying to bait Geoff. Jeff's talked to me about this privately. Okay, let's be honest. Why is it something that you would probably not invest in? Not probably. You definitely would not invest in.
Because of the types of loans they're making and where they're making them.
Okay,
So it
expand.
concerns me, both of those. But it's not just them, by the way. I wrote up an insurance company. Insurance is very similar to banking in a lot of ways. Wrote up an insurance company that's originally was a Norwegian insurance company expanding into different sorts of things. The way in which they expand into different stuff concerned me. It's just that if you're wrong about... If management is wrong about the way that they're pricing things, if the risks that they're taking, it will fall apart pretty quickly. Compared to the banks we were just talking about, those are very centralized operations, I would say. I think Bank OZK or Bank Ozarks or whatever seems to me to be very centralized in terms of how big risks it's taking, how high up in the organization. So it's hard for me to evaluate. If someone's running it who's a genius, then you're fine. Or a team of people who are geniuses or who have a better mousetrap, in terms of pricing these things and stuff. So, I don't have details on how they do that. And they could be much better than anyone else.
There's this quote here on runways by Chuck Haker, who's very known for focusing on incredibly high return on invested capital type businesses, right? I think if you actually read his presentation, it's like all pretty much spent on that. Or he did a Google talk and it was pretty much all on that. He says, in our office, we often say, how wide and how long is the runway?
Yeah. And I can think of that with a bunch of the businesses that he invested in.
And
he seems to get out of them when he doesn't see the growth potential anymore going forward. That seems to be why.
And it's interesting, when I was reading this last night, it was even talking about Amazon, right? And how Amazon's like this $1 trillion company, and it's like, okay, so what's the runway look like there? I would still, even like the retail side of Amazon, the online retail, the e-commerce, it's still probably big because they still don't own like 100% of the market. And I mean, not saying that they could ever get to 100%, but will it be bigger 10, 15, 20 years in the future?
We talked about this before.
Probably,
FANG
right?
stocks, Amazon has much more runway than any of the other FANG stocks. Much more.
Why do you say that?
They have much lower market share in much bigger markets. The other stocks, things like Facebook and stuff, have huge market share in advertising, which is there's not that much left of it. Google and Facebook make their money basically off of advertiser-supported media stuff. They already are a really big share of that, and that's not growing that fast. Amazon, what's its market share in groceries or something? It's not big at all, and so that's a huge market that it can invest in. And there's whole sections of retail that's not big in, and there's whole parts of the world that's not big in. So.
There was a very interesting part in this article that I thought it was definitely worth talking about. It says, not selling a stock that delivers exceptional returns can result in a quality problem. The stock becomes a large part of the portfolio. So we were just talking about not selling it, right? And he was talking about Ted Weschler, his position in W.R. Grace. It became almost 50% of his fund before he closed his fund to join Berkshire Hathaway. And then it was also, one thing I thought was interesting was when Lai Lu delivered a 200% plus fund return in 2009 as BYD skyrocketed 400%. It also became over 50% of his partnership.
Yeah.
So I think it's interesting. If you're going to invest this way, you are going to have some serious volatility, right? If you're going to hold these stocks and they become a massive part of your portfolio.
Yeah, and reporting is the problem, especially if you're reporting quarterly or something.
Yeah.
So if you're reporting quarterly, you run into this problem because even if the stock does great even year to year, if you happen to end a quarter at a point where the stock was priced pretty high, a not even very big drop. If you half of your so let's say half your portfolio is in BYD or something, right? BYD.
I mean, we experienced that with NACCO,
right?
And you're like, I feel kind of dumb having to explain this sell off when the stock's been up whatever it was on the year,
right?
Yeah.
So for clients, it was generally up, and it was up a lot on the year. But it happened to be that our quarter ended. One of the quarters ended like the week that the stock was at the highest point it had been. And not just the highest point, but it went up a lot the week before the quarter ended. So the problem that you have there is it drops to a point which is the same point it was 6 months ago or something. But you're talking about it because for the quarter, and that's a problem that individual investors don't have.
And it was still a great return year over year, though, is what I'm saying.
But the individual investors don't have to focus on that.
Yeah.
The reporting thing. So the weird things about reporting, and that can happen with the year too, but it's more likely with a quarter. So you have things where you go, you have stocks that are up for the year, and yet you're saying we were down for the quarter because of this. And that's likely when you have very high concentration, right? So if it was 50% in BYD drops 10% for a quarter. It wouldn't be bad at all. That's 5%. That's the difference between you having a great quarter compared to the market, starting your letter off with, and not a good quarter. And so a lot of people are cautious about that. You mentioned the Apple thing. The problem obviously wasn't that active managers didn't own Apple. It's that they own 3% of Apple instead of 100%.
Yeah, and one thing that I thought was interesting from this this write-up, which everyone, again, be sure to check this out on masterinvest.com. It says a large position can also constrain your decision-making if it leads to commitment bias. Li Lu's fund struggled in 2010 and 2011 as the BYD share price declined nearly 80% from its 2009 high. By the end of 2012, the position size still represented 1/3 of the fund. By 2014, the position size had been substantially reduced to 10% as a result of the new investments by limited partners and other portfolio gains. With the benefit of hindsight, Mr. Liu questioned his decision regarding the proper sizing of BYD after the market gains became so large. In the end, he felt commitment bias had constrained his decision-making process.
Yeah, and I think he might be right that commitment bias did it, but it's also true that the experience of managing money for other people and it drops that much in a few years would be a reason why you don't want to do that, and why I said it's an easier strategy, I think much easier strategy for individual investors to follow than it is for someone who's managing a fund.
Yeah, because now you're getting new money in and stuff like that. And even when it was 50% of his fund, he wrote a letter to his investors saying, expect extreme volatility going forward. Right. When this one position represents 50% of our fund, you're going to have massive volatility. Right. So coming from like a money manager perspective, obviously individuals have a total advantage.
Individuals don't have to even look at what their return is for the year. Individuals can just look at it and say, I'm up 3 times in this stock. This stock has done better than the market since I bought it. I like the stock, so I'm going to keep holding it. And not have to worry about, in each of the last 2 years, it's down a big amount. They don't have to worry about that.
So what is the art of selling then? That is the title of this podcast. In your opinion, so is it the never sell, or is it the art of never selling? Is it the art of selling?
Well, it only makes sense to never sell.
Is it the art of the deal?
It only makes sense not to sell if you're right about the business in the first place and you continue to feel the same way about the business. So putting price aside for a moment, which we'll get into, that's the first thing. So I would say you have to be right about the business in the first place. Many of these are concentrated investors, you'll notice.
Yeah.
So I think people who are more diversified will sell faster, so this isn't an issue for them. And so you have a lot of commitment to it and all that early on. But if you still believe that it's doing what you expect it to do early on, years later, and the price is just up a lot, then you just have to evaluate it versus the price. Now, I would say, generally, I was just talking to someone on email about this. In my opinion, the time to consider selling is so when you value a stock in terms of an intrinsic value, usually you don't want to use a stock price. So you don't want to say, I'm going to sell, this stock is worth $50 a share. You want to say this stock is worth 2.5 times sales, or book value, or whatever it is. So when you look at that and try to readjust the intrinsic value, if you're still saying that the multiple in your mind, the multiple still should be worth as much or more, then I think you should be pretty comfortable with it. But if you evaluate it and say, okay, actually this isn't any more worth as much on a multiple basis as I thought it was, then you might want to consider selling it. And you want to be very cautious of letting that get bigger and bigger as a part of your portfolio. The other one is just selling it because you need to replace with something else, which can happen when it gets very expensive and some other thing you own gets cheap. And that does happen sometimes. In general, I would say probably our mistakes have been not selling losers fast enough, though we sell them faster than a lot of people do. A lot of value investors do. And not owning winners for very long periods of time would probably be it. But when I say winners and losers, what I really mean is in terms of the compounding of the intrinsic value while you own it and what you think about it that way. So
I think that's the hard part. Is it's so hard to come across these incredibly high quality businesses. Right. So let's say you own a business that is now trading at 30 times earnings, but it's still growing its intrinsic value by, I don't know, whatever you think per year, better than the average or better than these other companies. And then you have a different business that's at 7 times earnings that you think is undervalued. That's when you're like, what do I do?
Right, exactly. And that's usually what happens, is that the mistakes are selling something that is higher quality and higher priced to buy something that's lower quality and cheap. Now, other people might make other mistakes. We're generally going to make that mistake because we'd be cautious about something getting really expensive, and also we just are not we haven't generally made the mistake of paying a lot for something that turned out to be not a good business. The only times that we've made really bad mistakes in terms of business quality are buying very cheap things. We haven't misjudged something that's very expensive. That does happen to some other people, though. Some growth things and more speculative growth stuff can do that, where you can pay 30, 40 times earnings and then those earnings decline a lot, commodity type things can be that way. But it hasn't happened to us because I think we've only paid really high prices for things that are very predictable growth, and that would be the same as like Buffett or something like that. If he's going to pay a very high price, it means he likes the stock a lot in terms of the durability of the business, right?
But I mean, think about when he has sold companies. I mean, IBM. He sold IBM.
And that he felt that was a mistake and sold it. There have been other companies that I noticed he seems to have sold that would have made sense to hold on forever. So I did notice that he seemed to have sold General Dynamics in the 90s. And if he had held that for 15 to 20 years, he would have beaten the market in it by quite a bit, I think. So that was an interesting one. And that one, I know he got involved in sort of like a special situation and then decided to stay in it for the business changing.
So do you think it really comes to like the portfolio manager decisions as opposed to like the analyst decisions? Do you get what I'm saying?
Yeah, I do think that, because unfortunately,
it's like, what's best for the portfolio, as opposed to, no, I think this business is great. It's still going to continue to grow for years to come.
I think that, because I just said that I thought individual investors are the ones who are best able to do this, and Buffett has a holding company where people aren't doing the calculations on how big the position is at times. He let Geico get huge as a position early on. He made a very big investment in it and it went up right away. If he had been managing a partnership or something like the investment he made in American Express, there'd be more to have to talk about and do all that. Whereas if you're doing it as an investment in a holding company structure, he doesn't really talk. I mean, he doesn't go into detail of like people calculate on websites. We might calculate how much he has in each thing, but he doesn't go and tell his shareholders, well, 20% of our stock portfolio is in Wells Fargo or Heinz or whatever. That's not what he does. So they don't focus on that. But of course, if we write a letter, we're going to talk about things like that. And so it gets people focused on those kinds of concentration things. I think it's a very, very hard strategy for someone to follow if they're a fund manager, although there are examples of people who did it.
Which is why right here, see this part? You need aligned investors.
Yeah.
It's the paramount in light of potential for outsized positions and volatile returns. Educating investors and preparing them for an absence of portfolio activity is a sensible strategy.
Okay, and you know what the biggest problem here is with this? That they keep taking in new investors. So that's
Yeah.
the problem. So when you keep taking new investors, what ends up happening here with a fund, for instance, that does great on a performance and then has some years that are down because it owns a lot of the stock.
Yeah.
So some people are ecstatic and don't care that that the fund is down 20% this year because they were there when it was doubling and everything because of this position. And
you have one client that loves you and one client that hates you.
And then the one who just joined, of course, thinks, okay, well, I only got the part where the stock went down, so they're not happy about it at all. And that would happen with like Lee Lu or something, I'm sure. If you, if you joined after BYD went up a bunch, then you don't care about the fact that, the original decision made a lot of sense.
Sure.
Right.
No, I think that's great. Well, I want to thank everybody so much for tuning in with Mr. Geoff and myself on the #1 value investing podcast in the world. If this is the first time that you are tuning with us on YouTube, hit that subscribe button, thumbs this video up, leave us a rating review on the podcast side of things. That goes so far for us. 160 plus podcasts in, and we are innovating and we are educating. That's our new motto, innovating and educating. Thinking of new ways to bring new content to you guys. And obviously the support means so much to Geoff and myself. If you do sign up for the website, Geoff is going to write up 250 plus write-ups this year. Be sure to sign up using the podcast promo code if you like to save $10. If you don't use the promo code and it'll be $60 a month as opposed to $50 a month. I want to thank everybody so much for tuning in with us. We'll see you in the next podcast. Take care. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.